As we begin the second video looking at the indirect method, it's important to point out that selecting whether you will utilize the direct or indirect method only applies to the operating section of the statement of cash flows. In the third video, we will finish off the investing and financing section of the statement of cash flows using the direct method, which is the only method acceptable for those two sections. So let's begin looking at the same operating section, but now using the indirect method. With this method, the goal is to begin with the net income direct from our income statement and work backwards to adjust away any items that would not have impacted cash. So for example, in the direct method, we ignored depreciation as it had no cash effect, whereas in the indirect method, we often start with depreciation to remove it from net income. So to begin, we're going to go ahead and record net income directly off of the income statement. So taking a look at Bandit Corporation's income statement, we're going to pull that net income and drop it right in as the first line on our statement of cash flows operating section using the indirect method. Again, we're going to start with depreciation expense, which also we will get directly off of the income statement. So we'll take our depreciation expense of $58,600 and we're going to add it back to net income as it was subtracted from net income, but it had no cash effect. After we've got depreciation expense added back into net income, we're going to take a look at any gains or losses that also were included in net income but didn't have a cash portion of it. So next on the list here is gain on sale of equipment. We can see on our income statement that under other income there was a gain on sale of equipment for $2,000. Now, although cash does exchange hands when it comes to purchasing and selling equipment, when we have a gain, it's because our book value often is different than the fair value of the equipment that we might be selling. So there's not necessarily cash exchanged, but it's a difference between our book and fair value. So we're going to go ahead and subtract out the gain that has so far been included in net income, because if there wasn't actual cash exchanged, then we need to subtract that out from net income. All right, so once we've started with net income and addressed those non-cash items that we knew were hidden within that net income number, we just reversed out their effects. We're going to move on to taking a look at our balance sheet. And what we want to do is take a look at those same balance sheet accounts that we used when we were looking at the direct method. And we want to go ahead and analyze how the account changed and move that change over to our statement of cash flows using the indirect method. So as we go through the balance sheet and we take a look at each one of our operating related accounts, and we're going to take a look, see if it increases or decreases, and we'll transfer that increase or decrease to our statement of cash flows. And I'm going to help us out and give us a little bit of a guideline here. If we're looking at asset account, if we see our asset account increase in terms of does the balance increase, then on our statement of cash flows, we're going to want to decrease or subtract that from net income. Okay? If we see a decrease, then our statement of cash flow is going to increase. If we're on the liability side though, it's going to be different. If we see an increase on the liability side, then our statement of cash flow is going to increase. And if we see a decrease, then our statement of cash flow is going to decrease. So it's going to agree on the liability side, it's going to do just the opposite on the asset side. So let's go ahead and apply this kind of guideline as we go through each account. We've done a lot of the work already, so let's look at our accounts receivable account. We had a beginning balance of $51,000. We had an ending balance of $65,000. we're showing an increase in an asset account. Okay, so you'll see these blue labels here. I just went ahead and calculated the difference, or what was the change, what was the amount of the increase. So for accounts receivable, throughout the period, so from the end of the year 2016 through end of the year 2017, accounts receivable increased by $14,000. It's an asset account, so I'm going to look at my guidelines. If I have an increase in my asset account, then I'm going to want to go ahead and subtract it from my income. Let's take a look now at inventory. My merchandise inventory. I had $86,500 as my beginning balance. I had an ending balance of $63,800. So my asset account decreased by $22,700. If I have a decrease in an asset account, then my statement of cash flow is going to increase $22,700. Let's look at prepaid expenses. Prepaid expenses, another asset account. Started the year with $5,400, ended with $4,400, a decrease in $1,000. If I have a decrease in an asset account, I'm going to transfer it to my statement of cash flows as an increase. Accounts payable. Now we're moving over to the liability side. Let's take a look at my accounts payable. Accounts payable, I had a beginning balance of $30,000. I had an ending balance of $25,000. I had a decrease of $5,000. In a liability account, if I have a decrease, then my statement of cash flows, I'm also going to show a decrease. Let's take a look at salaries payable. Wages payable, beginning balance of $15,000, ending of $6,000, a decrease of $9,000. Again, if I have a decrease in a liability, I'm going to have a decrease on my statement of cash flow. The last one we're taking a look at here is our income tax expense payable. Again, a liability account. We went from $3,800 to $3,400, a decrease of $400. I'm going to go ahead and drop that into my indirect method operating section of my statement of cash flows. So right away you notice we have come to the exact same number whether we use the direct method or we use the indirect method. That's a good sign. So again, with the indirect method, we started with net income. We backed out or added back any of our non-cash items that we just didn't even address in the direct method, like depreciation expense and gain and sale of equipment. And then we looked at each balance sheet account just as we did with the direct method, but we focused only in on the change in that account and how the change in that account would have affected our net income in terms of whether or not it would have impacted our cash. So we used our guidelines down here for our assets and our liabilities, plugged our balance changes into the operating section, and lo and behold, we came up with the exact same net cash flows for operations. At this point, I'm going to end this video. In the third video, we're going to take a look at finishing off the investing and financing section of the statement of cash flow. So again, statement of cash flows has 3 different sections. The first section, you get to choose whether you want to use the direct or the indirect method. But when it comes to the investing and financing activity sections, we're going to go back to the direct method regardless of which method you chose for the operating section. See you next in video 3.